In this part, I'm introducing the cost flow assumption. This part regarding when the firm sells its inventory. We know if a firm has inventory, its inventory the firm the purpose of holding inventory is to sell them and earn revenue. And inventory will finally be expensed and recognized as cost of goods sold. So, how to determine the cost of goods sold relies on the cost flow assumption. In the financial accounting, we have several assumptions applied to different firms. The methods or assumption applied should be clearly reflect the periodic income. Basically, it's to make sure the earnings quality. First one is specific identification. This one is preferred for the industry or firms who produce the personalized items. For example, the jewelries, housing. And average is very simple. So we just use average cost to calculate the cost of goods sold. FIFO means first in, first out. So if the inventory was acquired first, it should be sold first. LIFO is last in, first out. That means which one was last purchased will be considered sold first. Keep in mind, these are all assumptions. They may not consist with the physical movement of the goods. This is for accounting purpose. If a firm adopts a method or assumption, it should keep using these methods. Although firms can change their assumptions, it will result in restatement. In this section, I'm going to use this example for the 4 different methods. To make my lecture easier, let me switch to a Word file. This is an example. I'm going to introduce the determination of cost of goods sold and ending balance of inventory based on different cost flow assumptions. Let's first obtain the information we need. There is a purchase, which is the first purchase on March 2nd. The number of units is 2,000. And because we don't have any other information, so we just assume the March 2nd purchase is the beginning balance. Number of units is 2,000. The price is $4, so the dollar amount, the value or cost of inventory is $8,000. There are 2 purchases on March 15th and March 30th. So for the purchase, the first one is 6,000 units. Unit cost is $4.40. The second purchase is 2,000 units. The cost is $4.75. From the first March 2nd to the last purchase March 30th, the cost of inventory keep increasing. It is rare for a cost of inventory increase in just 1 month, but we know that's just an example. In the long term, the cost of inventory may increase or decrease. And for each purchase, the cost is 26 for the first, 9,000 is for the second. Okay, so total goods available for sale, number of units is 10,000 and the cost is 43,900. Based on the equation I introduced in the prior lecture, so the beginning balance of inventory plus purchased equals ending inventory and cost of goods sold. Okay, we have beginning inventory, we have purchase, so this is goods available for sales. On the other side of the equation is ending inventory and cost of goods sold. Let me just use goods sold. There is one sale. The number of units sold is 4,000 units. So here is 4,000 units. And the product price and number of units determines the revenue. But in this part, we just focus on the cost of goods sold and the ending balance of the inventory. So here we have one issue. We have 4,000 units sold. We have 10,000 available. And for the three purchase, the costs are different, right? So from which purchase the goods or inventory sold will determine the cost of goods sold and ending balance of inventory. This actually relies on assumption the reporting firm applies. Next is ending balance of inventory. It's 6,000 units. And this assumption will determine both cost of goods sold and ending balance of inventory. The first assumption is specific identification. So this assumption applies to the industry or firms who produce or sells personalized product. For example, jewelries, housing, because each product can be differentiated from each other. So the cost of each item is different and also can be recognized specifically. As we know, there are 4,000 units sold, and the ending balance of inventory is 6,000 units. Okay, so if we know 1,000 of the 6,000 units is from March 2nd purchase, 3,000 are from March 15th, and 2,000 from March 30th. So we will learn the 4,000 units sold, 1,000 must from March 2nd purchase, and the 3,000 are from March 15th. Okay, both combined is 10,000 units. 2,000 from March 2nd, 6,000 from March 15th, and 2,000 from March 30th. We can recognize from which purchase the inventory are sold or the inventory are left as ending inventory. So we can calculate cost of goods sold, which is 1,000, multiply the price on March 2nd is $4, plus 3,000, multiply the price on March 15th. The value is 17,200. So ending inventory 1,000 multiply $4, 3,000 multiply 4.40, and 2,000 multiply $4.75. It is 26,700. Okay, and because we know the sum of both equals the goods available for sales. So if we calculate this one, ending inventory also equals to the goods available for sale subtract cost of goods sold. It's 43,900 subtract 17,200, which is 26,700. The next one is average costs. So average cost is very simple. It does not distinguish to what purchase the inventory are from. We just calculate the average cost of all the purchase. The total cost of inventory for the three purchases is 43,900, and the number of units is 10,000. The cost per each unit is $4.39. The cost of goods sold, we know, is 4,000 units. We just multiply $4.39, so which is 17,560. Ending inventory 6,000 units, multiply $4.39, it is $26,340. Again, you can still use 43,900 subtract 17,560. It will equal 26,340. Another one is moving average cost. The difference between the moving average and the average cost I just introduced is what purchase we use to determine the average cost. Okay, let's take a look at the 4 dates. We know the sold happens on March 19th. In reality, on March 19th, when the firm sells 4,000 units, it has not made this purchase. So this information is not available by the end of the month. The moving average means we just use all the purchase available to determine the average cost. So because before the sales, there's only 2 purchase available. So the cost of this inventory is determined by the average of the first 2 purchase. So let's first calculate the average cost. So the average cost is 2,000 multiply 4 plus 6,000 multiply 4 and 40 cents and divided by 8,000 units. So the average is $4.30. So the cost of goods sold now we can calculate 4,000 multiply $4.30. Okay, so the cost of the inventory sold is determined by the average of the purchase before this sales, and it is 17,200. So the ending inventory is 43,900 subtract 17,200, that is 26,700. The next one is FIFO, first in, first out. This assumption means the goods are sold in the order in which they are purchased. So this is more consistent with the physical flow of goods for a lot of retailers or grocery stores. When we use FIFO or LIFO to calculate the cost of goods sold or ending inventory, we should also consider the inventory system the firm applies. So if a firm applies periodic inventory system or perpetual system, the results will be different. Periodic system, based on the order of purchase, this is the first one, second, third. In the periodic system, we know the inventory is only updated at the end of the accounting cycle. When we consider which inventory are sold first or last, we consider all the inventory during this period. To calculate cost of goods sold, we need to know the cost of the 4,000 units. Because first in, first out, the first purchase is the 2,000 units on March 2nd. 2,000 units are from March 2nd. Another 2,000 units is from the second purchase. Okay, so this is March 15th. Then the cost of goods sold will be, so that's the number of units. Okay, so the cost will be 2,000 multiply $4, 2,000 multiply 4.40. So the cost of goods sold will be 16,800. We can also calculate ending inventory, which is 43,900 subject 16,800. So ending balance of inventory is 27,100. Also, if you calculate the ending inventory first without the value of cost of goods sold, you can also check. For example, there will be 4,000 units left, 2,000 left, and multiply the cost per unit. You can get the same result. So the FIFO perpetual inventory system is very similar to the moving average. Perpetual inventory system is updated when there is a transaction affects inventory. Before this sales, the firm only have these two inventory available. So we can use the inventory available to determine the cost of goods sold. So the number of units for cost of goods sold, 4,000, and again 2,000 is from March 2nd, and 2,000 from March 15th. And actually we get the same results. Okay, the cost will be 16,800. Also, end inventory $27,100. So we can conclude, when the firm use FIFO, so the periodic and perpetual are equivalent. The next one is LIFO. Again, we still need to consider the inventory system the firm applies. First, second, third. Okay, LIFO means last in, first out. So when we determine the cost of goods sold and end inventory, we use opposite order of FIFO. Periodic system, we will consider all the purchase. And last in, first out. So cost of goods sold, number of units, 4,000. Last in, first out. So last in is March 30th. Is 2,000 units. Is March 30th. And another 2,000 units are March 15th. Okay, the cost 2,000 multiply the cost per unit 2000 multiplied cost per unit. So cost of goods sold will be 18,300. And to determine the ending balance of inventory, we still use 43,900 subtract 18,300 is 25,600. Next one is a perpetual inventory system. And before these sales, the purchase on March 15 is the last purchase. So again, we do not consider this one. So the units cost of goods sold 4,000 equal, because the purchase on March 15 includes 6,000 units. So that's enough for this purchase. So the cost of cost goods sold will be 4,000 multiplied $4.40 is 17,600. And ending inventory. The ending inventory represents the inventory which are unsold or left. So we have 2,000 units left from March 2nd purchase. 6,000 purchased, 4,000 were sold, so 2 more thousand for March 15th. And another 2,000 are from the last purchase. Okay, so you can calculate and get is $26,300. Again, you can still use 43,900 subtract 17,600. It is also 26,300.